First of all, given the fact we're going to have the Fed make a more short-term decision, presumably, this week, how does that fit with the long-term interest rates? How should the Fed be taking into account some of what you say about long-term interest rates?
Long-term interest rates are probably higher for as far as the eye can see, and it probably means their R star, what they think of, what's their target, is higher than they've been thinking, and some of them still seem to be thinking. It collapsed after the financial crisis, and there's been some reversion to mean. We've seen it in the long rates, and I'm not sure the Fed's entirely figured out that some of that will happen with the short rates as well. So I think one Fed governor said we thought we had 2 feet on the brakes, but maybe we only have 1 because interest rates aren't as high as they seem.
How much influence does the Federal Reserve have over long-term interest rates? One of the things I took from your paper, at least, is that we had a period of low inflation, but it may have been for forces much larger than any central bank. It had to do with things like globalization and some of what's going on in unions and some of the lack of conflicts. How much influence does the Fed have over long-term interest rates?
Well, there are 2 parts to long-term interest rates. There's the real interest rate, and I think the Fed's long-term influence is actually very limited. It follows the flows of international markets. Yeah, quantitative easing matters because of the Treasury issues lots of short-term debt and very little long-term debt, or the Fed helps it do that. That lowers long-term interest rates, but it's risky because, as we've seen, when interest rates go up, it can cost the U.S. a lot of money. On inflation, I mean, I think, of course, the Fed's heart is in the right place, but it's hard to be a island of technocratic tranquility in the middle of a sea of political turmoil. The Fed is independent, but the governors get appointed, the Fed chair gets appointed. Over the long run, they can control the Fed's budget, a lot of perimeters around its regulation. And political pressures matter. I mean, they don't have to be so crude, as I'm sure you're going to ask me about Donald Trump and some of the proposals. But I think in more subtle ways, they matter. And as you say, there was this long period of globalization, fiscal prudence, Washington consensus, deunionization. I'm not praising that, but it made it easier for the Fed to bring down inflation and maintain decent growth. Everything's going into reverse. Certainly, fiscal policy's long gone into reverse. Globalization is at least slowed down, might be going into reverse. A number of other factors. And it's going to be harder. I think for those reasons, and my co-authors, Hassan, Marina, and Pierre, all think that we're going to have, on average, higher inflation. Now, to be clear, I'm not saying the Fed's not going to bring inflation down to 2% this time. I think it might. But we're going to see more upward spikes like we had over the pandemic on occasion, and not so much these long periods of deflation.
Well, you're right. We are definitely going to get to that Wall Street Journal reporting about, of course, Donald Trump and what influence he might seek to have over the Fed. But let's just complete the thought on maybe when it comes to inflation and, of course, that decades-long shift to lower inflation, that central banks and the Fed had less to do with it than maybe commonly thought. If that's the case, when you think about the inflation that we're dealing with now, should that realization, if true, impact how they're approaching the current inflation that is in the economy?
They did a great job, but they had the wind at their backs. Now they're running into the wind, and it's harder. I think here, the big issue is not simply the embedded inflation, but where is the long-term real interest rate going to go? In other words, how high a Fed funds rate do we need to get the right real interest rate? They'd been thinking, I think, for a long time, 0.5% real interest rate. And maybe that's right, but there's little question the long rates have gone up. And even after the Fed unwinds its interest rate hikes, I think they're going to stay high for a very long time. And so maybe interest rates aren't as tight as they think. And I'm sure that kind of conversation's going through the halls of the Federal Reserve now. They just have to be rethinking things.
So, Ken, let's go to that question about the reporting about what perhaps President Trump might do if he were reelected. It is reporting, and the Trump camp specifically has not said that's where they're headed. But if, in fact, there was a move by a new Trump administration to really take away from the independence of the Federal Reserve, how much difference would it make? Because it sounds like you think there's going to be pressure on not just the Fed, but other central banks, no matter what happens.
Yes, I do. So it won't be as crude as the rumors that we're hearing about from President Trump. I don't think we're going to go to the extremes of Turkey, where President Erdogan kept firing his central banker every other year when they tried to raise the interest rate. I don't think we're going to get there. But almost no matter who's in power, they're looking for ways to try to loosen monetary policy. The progressives have ideas for taking away Fed independence, too. They're not at the tip of the tongue of President Biden or Jared Bernstein and his advisors, but they are ideas floating out there. And the thing is it's not going to work very well. I mean, it's going to be obvious that it's not working. If you take away Fed independence, investors are going to get jittery, inflation expectations are going to go up, the dollar is going to tank. So happily, for better or for worse, maybe, I think markets will throw a pretty cold bucket of water on the president if he tries to do that. I don't think he would go to that extreme, but it's clear, he wants to be disruptor in chief, and it probably irritates him that Powell gets so much attention at his press conferences.
So markets there would apply the brakes in that scenario, which, of course, still being reported out, details unclear, so we won't go too far into the hypotheticals. But let's talk a little bit more about real interest rates. If we do enter into this environment where you have these episodic spikes of inflation, what would sustainably higher real interest rates mean for this economy when you think about the potential ripple effects?
Well, I think it really comes in the cost of borrowing for the government, for individuals. So remember, inflation's also driving up tax revenues. It's also driving up wages and salaries. But the real interest rates, they're there to stay. They're the wedge between the two. And this world, there's this period where you were just a sucker not to borrow as much as possible, whether it was to buy a larger house, whether it was to fund new government programs, et cetera. And I think, we live in a more normal world now. I'm not saying I'm telling you what interest rates are going to be for the next 20 years, but what I am saying is I think on average, they're going to be a lot higher than they were after the global financial crisis.
Ken, one last quick one, if I could. What does it do to growth if we have long-term interest rates?
Well, we've had long-term interest rates a lot higher for a long time and had better growth than we have now. It sort of depends on what's going on. I think to the extent it's driven by huge government borrowing, private borrowing, it's clearly a negative. You're just paying a risk premium to borrow. To the extent it's driven by AI and productivity and wondrous new technologies, then obviously high rates just go hat in hand. Maybe there's some of both.